Welcome back to the channel. Today we're unpacking a topic that's vital for any entrepreneur, founder, or small business owner looking to start or grow a company. How do business loans work in the United States versus the United Kingdom? Stick around because we're going to break this down carefully. How loans are structured, how easy it is to qualify, interest rates, government support programs, collateral requirements, and cultural differences in how small businesses access finance. 1. The business lending landscape. United States. The U.S. business lending market is enormous and diverse. Small business loans come from traditional banks, online lenders, credit unions, specialized institutions like the Small Business Administration, SBA, peer-to-peer lending platforms. The U.S. also has a strong private lending ecosystem, and online fintech lenders play a major role, often offering faster approvals but at higher interest rates. United Kingdom. The UK market is more bank-dominated. Business loans are available from high street banks, challenger banks like Starling or Metro Bank, online lenders and peer-to-peer platforms, government-backed schemes via the British Business Bank. The UK market is smaller but has become more competitive in recent years due to fintech entrants and alternative lenders. 2. Loan types. In both countries, businesses can access several types of loans. Calendar with marked repayment dates and lump sum cash graphic. Term loans. Lump sum loans with set repayment schedules, most common. Lines of credit. Flexible borrowing with limits akin to a credit card for business. Invoice financing, borrowing against unpaid invoices. Equipment financing, loans specifically for purchasing machinery or equipment. The broad loan categories look similar, but how they're priced, collateralized, and accessed differs. 3. Government-backed loans. United States. The Small Business Administration, SBA, provides guarantees on loans issued by partner lenders, reducing lender risk and helping businesses that might not qualify for a traditional bank loan. SBA 7A loans are especially popular for general business purposes, with loan limits up to $5 million. SBA loans often come with attractive terms, long repayment periods, lower down payments, but can take longer to process due to paperwork and eligibility checks. United Kingdom. The British Business Bank, BBB, doesn't lend directly but partners with lenders to guarantee loans. The UK offers programs like startup loans, unsecured personal loans for startups of up to $25,000, and recovery loan schemes aimed at supporting businesses post-pandemic. UK government-backed loans tend to be smaller in scale than SBA loans in the US, but offer similar risk-sharing benefits for lenders. 4. Typical interest rates. United States. Rates depend on creditworthiness, lender, loan type, and collateral. Bank term loans, 6% to 10% annual interest typical in 2025. SBA-backed loans, around 7% to 9% for well-qualified borrowers. Online lenders can charge much higher rates, 15% to 30% plus, for fast approvals and unsecured lending. Rates vary widely based on business credit score, financial history, and collateral. UK bank building exterior with people entering. United Kingdom. Bank loans in 2025 typically range from 5% to 8% for small business term loans. Unsecured loans or those from alternative lenders can run higher, 10% to 20%. On average, borrowing rates for small businesses are somewhat lower in the UK compared to equivalent US loans, reflecting historically lower base rates and market conditions. 5. Collateral requirements. United States. Lenders almost always require collateral for traditional business loans. Common forms: business assets, personal guarantees, real estate or inventory, personal property in some cases. SBA loans reduce collateral requirements, but most small business lending still involves significant personal guarantees in the U.S. United Kingdom. UK lenders also prefer security but often rely on debentures, a charge over business assets, personal guarantees, fixed charges on specific assets. Personal guarantees are common in both countries, but collateral requirements may be slightly lighter in the UK for smaller loans or fintech lending platforms. 6. Loan terms and flexibility. United States. Typical business loan terms: 1 to 10 years for term loans, longer for real estate loans. Monthly repayments fixed over term. U.S. lenders sometimes allow early repayment but may charge prepayment penalties. United Kingdom. Typical loan terms: 1 to 5 years for small business loans, up to 25 years for property loans. UK lenders generally allow early repayment with fewer penalties than U.S. lenders, encouraging faster debt repayment if cash flow allows. 7. Ease of access and application process. United States. Bank loans require detailed documentation, business plan, cash flow projections, personal and business credit reports, tax returns. Traditional banks have strict underwriting standards. Fintech lenders are more flexible but expensive. United Kingdom. Banks also require comprehensive documentation, business plans, financial statements, directors' personal information, The rise of challenger banks and online lenders has improved access for startups and small businesses, but traditional banks still dominate lending. 8. Credit history and scoring differences. In the U.S., business credit scoring via Experian, Dun & Bradstreet, etc., plays a critical role. Personal credit history also heavily influences loan approvals, especially for small or new businesses. In the UK, credit checks focus on both the business and its directors. UK lenders use credit reference agencies like Experian UK, Equifax, and TransUnion. Personal credit history tends to play a larger role in small business lending in the US than in the UK, where business viability assessments often carry more weight. 9. Cultural attitudes toward borrowing. In the US, debt financing is normalized. Borrowing to scale a business quickly is common and culturally accepted. The venture capital ecosystem complements debt financing for high-growth startups. In the UK, business borrowing is somewhat more conservative culturally. UK businesses historically rely more on retained earnings and less on debt, though this is changing as fintech lenders encourage more borrowing. The US culture encourages risk-taking and growth through leverage. The UK culture has traditionally emphasized cautious borrowing and sustainability. Summary: here's what we've learned today. Both countries offer bank loans, government-backed loans, online lending, and alternative finance options, but the landscape differs in structure, cost, and process. Interest rates are slightly lower on average in the UK, but differences depend on credit profile, loan type, and lender. Collateral and personal guarantees are common in both countries, but personal credit plays an even bigger role in US underwriting. Government-backed loans are available in both markets. SBA loans in the US can reach $5 million, while UK startup loans are capped at $25,000 for individuals. Application processes are detailed in both countries, but US fintech lenders offer speed and ease at a higher cost. Cultural attitudes matter. Borrowing to grow is more aggressive and normalized in the US. Borrowing in the UK has traditionally been more conservative. That's it for today's comprehensive breakdown of business loans in the US versus the UK. If you're thinking of starting a business or expanding internationally, understanding these differences can help you plan better and set realistic expectations.